Okay, good morning everyone. So my presentation today is dealing with the topic of bank power and the struggle for Eurodollar market supremacy. And these are the first sort of fragmentary thoughts of mine on a chapter from my PhD thesis, which is dealing with the political economy of Anglo-American relations, particularly post-Second World War. So what I'm going to do in this presentation is to first of all, briefly define the Eurodollar market and give a very concise historical background. I'm then going to present a few different interpretations of what the significance of the Eurodollar market was for the global economy, before then presenting my own provisional arguments on the topic and showing some data that I've collected from the Bank of England quarterly bulletin. And then finally, I'll just recap and suggest some questions for further research. So first of all, what is the Eurodollar market and how did it come to be? Well, it essentially refers to the gathering and investing of short-term dollars in foreign markets, with particular reference to the use of the dollar outside of US national jurisdiction. And historically, London has been the main center for the Eurodollar market. So it emerged out of the context of the 1950s. And after the Second World War, European banks, particularly those in the UK, began to revive the practice of taking dollar deposits. And instead of placing these dollars in New York, they began to lend them out to other European banks in order to finance international trade. It was actually the Midland Bank in Britain in 1955 that first began to use dollars for domestic purposes within the UK. And the market really started to take on momentum after 1957. This is because the repeated crises of sterling in Britain after the Second World War meant that the government imposed restrictions on the use of sterling for financing trade between third parties. And so what we see here is the beginning in the shift from the significance of sterling as an international currency towards the supremacy of the dollar as the principal international currency. So the restrictions on sterling meant that the dollar became increasingly prioritized as the currency for international trade. It was the cheapest and readiest source of international trade credit. And we have to situate this within the context of what started to happen in the 1960s, which is the world moved from the situation of the dollar gap, in which particularly Western European countries were short of dollars, to the dollar glut of the 1960s, brought on by US balance of payments deficits and heavy overseas spending, particularly on the war in Vietnam. The important thing to remember about the Eurodollar market is that it was, at least at the time of its origin, an unregulated market. And so London had established itself as a zone of relative freedom from regulation as a means to attract international credit. So we compare this to the United States, for instance, where Regulation Q meant that there were interest rate ceilings imposed on short-term deposits. And this is a key factor in explaining why the Eurodollar market in London took on such significance. Okay, now I want to just sort of talk about some different interpretations of the significance of the Eurodollar market briefly. So a lot's been made about the emergence of the Eurodollar market and its significance for the global economy, and I think it's unanimously understood to be a key turning point in the history of international finance. It's a key moment in the liberalization of international capital markets that provided ready capital for the expansion of trade and investment associated with the acceleration of globalization in the 1950s and 60s. It also played a key role in undermining the capital controls and monetary management in place under the Bretton Woods system, in that it kind of cradled a more liberalizing tendency in the global economy. So Panitch and Gindin, in their theory of US imperialism, put quite a lot of stock in the significance of the Eurodollar market as a moment in which European capital markets were brought closer into a hub and spokes relationship with the money market in New York. And so they suggest that the Eurodollar market moved the city and European finance in general further into the American imperial embrace. Gary Byrne, by contrast, has focused his analysis more on what the domestic implications of the emergence of the Eurodollar market were in terms of the balance of power between institutions within the British state. And for Byrne, what's significant is that it reoriented the centre of institutional power within Britain back to the position in which it had been prior to the collapse of the gold standard in 1931. So he suggests that what we see with the emergence of the Eurodollar market is the re-establishment of the primacy of the City, Bank of England and Treasury nexus as the kind of fulcrum driving British government policy. Yusuf Cassis, the historian of international finance, suggests that the Eurodollar market's main impact was that it detached the interests of the City of London more and more from that of the British currency and the British economy. And although it strengthened London's international role as a financial centre, American banks were nonetheless able to take full advantage of the situation and were subsequently able to dominate the Eurodollar market and integrate it into their global strategy. And this is something that I'm sort of interested in focusing on in particular, the fact that this went from being originally a market dominated by the British banks in its infancy to something that was quickly taken over by American banks as they expanded into London. Stefano Battiosi suggests that the Eurodollar market constituted a potential challenge brought by European banks posed to American banks at the source of their post-war hegemony, their ability to mediate worldwide dollar liquidity. But he goes on to say that it was a challenge that was effectively met by the American banks, who reached an undisputed dominant position in the Eurodollar market during the 1960s. So what does all of this mean in terms of bank power and Anglo-American relations? The kind of questions that I'm interested in here for my future research is how the Eurodollar market plays a part in the interactive development between British and American capitalism and the decline of British power vis-à-vis America in the post-war era. How is the changing balance of power between British and American banks embedded within the broader framework of Anglo-American relations? And how might a capitalist power approach, as articulated by Nitzan and Bickler, facilitate our understanding of these kind of questions? I think in the broadest sense, we need to understand the rise of the Eurodollar market as intimately connected with the decline of the British Empire, and in particular the demise of sterling as an international top currency, as Susan Strange would describe it, which was then subsequently replaced by the US dollar. So I'm now going to move to some of the data that I've been collecting on the issue, just to show the changing market share between the different banks. I'm using the current account deposits of overseas residents here as a kind of proxy for Eurodollar market deposits, basically. So, and at this point, with this graph, it's basically sterling and other currencies too. Okay, so this second graph here shows American banks' overseas residents' deposits. But in this graph, I've plotted sterling against other currency deposits. And what we see quite clearly with the American banks is that the massive increase in deposits is largely to do with currencies other than sterling being deposited. And we know for a fact that these deposits were mainly in US dollars, essentially. Okay, by contrast, the British overseas and Commonwealth banks, which you'll remember from the previous graph, with the other most significant players in the market, experienced a much more gradual and lesser increase in non-sterling deposits, although they did begin from a higher base point of sterling deposits. So where we see that change in the initial graph, it's essentially to do with the massive proliferation of non-sterling deposits in those American banks. And we can use that quite clearly as a proxy for the acceleration of Euro-dollar market size. Okay, so my argument on this is basically to initially contend Panich and Ginden's assertion that the development of the Eurodollar market was seemed to be some kind of part of a purposive imperial strategy of integrating European financial markets into the American matrix. I think, in fact, what we see is corporate actors operating in response to changing regulatory and monetary conditions within the US and UK. And so we might want to think of this in terms of differential regulation. So these banks were kind of playing off different regulatory conditions in different territorial spaces to maximize profit-making possibility relative to one another. And we see, if we go back to this graph, what we see is that with the US deposits increase, particularly after 1964, that's where we see the most steep and consistent increase. And this is to do with changing monetary conditions in the United States in the early 1960s, particularly after 1964, where we see the imposition of tight money and credit restraints as American policymakers became more and more concerned with the growing balance of payments deficit and how that would affect their standing in the world. And so as these regulatory conditions in the US were tightened and there were limits imposed on American banks' lending and deposit taking, they then moved their operations more and more into London. And this is because British banking was effectively self-regulating prior to the Banking Supervision Act of 1979. So what we see in Britain is an entirely different regulatory context from that which is experienced in the US. So what does all of this mean in terms of dominant capital and in terms of Nitzen and Bickler's idea of cycles and regimes of differential accumulation? Well, to contextualize it historically, what's interesting about the American bank's expansion into London is that this came after a major wave of mergers and acquisitions within New York from the mid-1950s up until 1960. So for instance, the Chase National Bank merged with the Bank of Manhattan and Bronx County Trust to form the Chase Manhattan Bank. So we might therefore see the internationalization as the territorial extension of a breadth regime that took US banks outside of the national envelope of accumulation. In the process, national money markets became more tightly integrated. This caused interest rate standardization as well as a transnational spatial integration between these markets. And importantly, although we don't have the profit data here, and that's what I need to do next, essentially, I think it most likely increased the power of dominant capital within international banking. The same 5 American banks that dominated the market in the 1960s were still dominant in 1999 in the exact same rank order as they had been in the 1960s. So we see a remarkable stability in the kind of banks that were dominant in this foreign-oriented market over the last sort of 50 years. So Michael Darby suggests that you can identify 2 major groups of US banks in the 1960s, and he rather unimaginatively labels them large banks and small banks. But he suggests that since 1960, the balance of power shifted away from the smaller banks. And I quote him here, "The internationalization of banking in the last 25 years is part of this general struggle of large American banks to break their parochial fetters. And breaking these parochial fetters involved extending into London." Now, what were the effects of this extension into London upon British banking? Well, it appears to me, from most of the evidence I've gathered to date, that they were extremely deleterious to the health of British banking. And they accelerated a process of decline that really got underway intensively with decolonization and the post-Second World War context. The British banks, as we can see from this graph, were the major losers after a position of early dominance in the 1950s. Foreign bank expansion even came to undermine the position of British clearing banks, which I haven't put on this graph because they weren't major players in the Eurodollar market. But by the late 60s and 1970s, these American banks, which had taken a foothold in the London market, also began to challenge clearing banks for local corporate clients and sterling loans. So Jeffrey Jones suggests that there was a big threat from US multinational banks. The American banks, he suggests, were not simply strong competitors of the British overseas banks, they were potential predators. And he relates this to the first wave of mergers between British overseas banks in the 1950s, which he argues were conducted within the background of real or imagined American takeover threats. So Jones notes that while British banks had pioneered and dominated the first era of multinational banking, they had become modest players in the second one. So during the 1970s and 80s, Britain's overall decline continued to undermine the former competitive advantage of British banks, associated with them being sterling banks and British imperial power. US banks benefited from the expansion of US multinational corporations, as they had privileged corporate ties to these companies. British banks had much smaller capital ratios that limited their potential involvement in the Eurodollar market. And they also suffered from a declining client base in the post-Second World War context. Now, an interesting way to trace the shifts in Eurodollar market dominance is to examine the Bank of England reports in the 1960s. And in 1964, if we read the Bank of England quarterly bulletin, they report, with a vaguely detectable note of pride, that accepting houses and overseas banks in the emergent Eurodollar market were well equipped to play an active part in this market. And they note the dominant role of these banks in the Eurodollar market. Now, if we contrast that to the 1970 Bank of England quarterly bulletin report, we find an analysis which basically suggests that the US bank's share rose substantially over the years and stood at 54% at the end of 1969. And I quote here, "The share of all other groups of banks fell, and in particular the accepting houses now only account for only 8% of the market total." So these were major losers in this competitive struggle over Eurodollar market deposits. So to make a couple of concluding remarks, I think that the re-establishment of London's role as an international financial centre, a key government objective, particularly for conservative administrations after the Second World War, came at the price of declining British banking competitiveness in an increasingly open global market. And that we can see through the early development of the Euro-dollar market a key moment in the hegemonic shift from the dominance of long-standing British multinational banking to the increased dominance of American multinational banking. And this was a process inextricably tied to the broader context of the decline in sterling's international standing and the increasing supremacy of the dollar as international currency. Thank you.
Good morning and good afternoon. Actually, it's in between. And thank you very much for having me here. Today, I'm going to talk about two investment banking cases. One is Merrill Lynch, the other one is Bear Stearns. So my work is still in progress. The two cartoons actually illustrate the dire situation they were having in 2008. What I am going to do is that first I will talk about the cases briefly and then talk about the literature on capital. After highlighting the problems, I'm going to offer a tentative theoretical framework and then look at the broader macroeconomic situation and provide a kind of timeline for these two investment banks that they run into trouble, and then analyze what happened before summarizing my conclusions. If we remember 2008, it was a very tough year for all financial institutions. There were three major investment banking casualties. The first one was Bear Stearns. Actually, it was established in 1923. It is a long history, but suddenly collapsed in March 2007. And then, in order to prevent the broader implications of the collapsing share prices, almost 50% in one day, JP Morgan Chase agreed to buy Stearns with the financial help. Federal Reserve assured around $30 billion. And the second case, after 6 months later, actually, Merrill Lynch also ran into problems, and after trying to solve its financial problems, it was forced to sell itself to Bank of America. So a year ago, both banks were very healthy, making around $1 billion profits. And what happened in less than 1 year, that these huge investment banks with around 80-something years of history collapsed. Well, these two investment banks and their collapse actually raise a question about what is capital. Is it a asset or it is a fund? When I look at the literature, what I could see, interestingly, is that first, the debate has more than 100 years of history in economics, and still very hot topic, as we can see here, all the discussions. And there are three forms I could see in the literature. The first one would argue that it is a physical asset, and John Hicks actually calls them materialists. And the second form is monetary fund, and he calls him fundist. And my former professor and now colleague, Professor Nissan, and his collaborator Bichler, actually adds a third category and saying that capital is power. So those who study the concept in the economic literature argue that both Avi Cohen and from actually York University and Jan Kregel from University of Missouri at Kansas City argue that economists tend to emphasize either asset side or material side or funding side. But what I will argue is that today that these three dimensions are important in the sense that the money without I'm going to explain that reason. Fund is important to buy asset to make more money, and without asset, tangible or intangible, fund does not have value, because if you look at the banking, the business, it is all about lending money. But at the same time, this third dimension, power, is important in the sense that capital is not a monopolistic category or a single category. Capital is a plural, and I'm going to hopefully demonstrate you how it works in the process of competition. So, in the literature, what I could see that there, this time dimension and the role of competition or business competition have been overlooked in the process, and hopefully I'm going to explain that through the theoretical framework I'm going to put forward based on Marx and Veblen's understanding of capital. So, first of all, capital in a capitalist society is an ownership category. It's all about ownership. And it has both physical and monetary side, but it is a plural category. And because of its plural nature, business competition is a very important role to play. And what I mean by business competition is a dynamic process where we see competitive behavior, competition as behavior of individual business firms, as well as a mechanism that exerts control over individual firms, depending on the market situations. In terms of theoretical framework, I work with both Marx and Veblen. Why? Because even though there are arguments about Marx's approach to capital as physical, if you look at capital volume first, actually Marx himself clearly stated that capital is takes the form that first of money. First of all, what he says indicates that in the first place, capital is about money. But given that the purpose of capital is to make money, we are talking about this process of realization. Money buys capital, commodities, but commodities not for the sake of commodities. It is because making more money. So it is a classic the realization transformation problem. And again, Marx's theoretical framework is useful because he talks about business competition and how business firms compete each other to make a profit. The second understanding of Marx capital is the social relationship, and that has to do with ownership. And ownership is sanctioned by the state in the form of private property. So these two dimensions, the capital as ownership category, and also having monetary and physical dimensions are important, but even some Marxists actually ignore these monetary dimensions, unfortunately. And why is Veblen? Veblen is important in the sense that he agrees with Marx about the nature of capital. First, that is ownership category, and with ownership, actually investors or the owners have, he argues, the right to abuse, neglect, or inhibit which are actually against the interest of the society. But the ownership gives these rights to owners of the capital. And capital can be tangible and intangible, but in the first place, capital, again, it is a monetary category. However, we can see in the form of investment in tangible and intangible assets. But again, the final the objective is to make more money. So in that sense, we see lots of commonalities between Marx and Veblen. First, it is plural. It is ownership category, it is fund, and also it is the physical category. So after seeing this framework, the next thing hopefully I'm going to show you is to outline the broader structure conditions about the American economy in 2006 before getting into the individual cases. 2005 and 6 was a kind of turning point in the history of American economy with reference to housing values. The 2005 and 6 kind of plateaued and slowly started declining. And also economic growth started to slow down compared to previous years. And what does that mean was that when the economy doesn't grow anymore, it means that there are fewer profit opportunities. And at the same time, the competition becomes more intense for two reasons, especially in the United States. The first one is that more and more banks enter into the mortgage business from both commercial and investment banking sides. And secondly, actually, industrial investment did not take off as much as the investment banks hope for between 2001 and 2006. That was one of the reasons why investment banks actually got into the mortgage business. They couldn't lend money to industrial players, and therefore they didn't want to sit on huge piles of money because they are about lending and borrowing in the first place. Then intense competition actually resulted in the decreasing profit margins, and here these broader macroeconomic conditions. We can see the first this orange is GDP growth dipping and then increasing, peaking around 2004 and then slowing down 4 and 5. And the second one actually is this interest rate, this green line. As you can see, until 2003, it declined significantly. Banks, could not find new opportunities, and therefore, they started lending to, these risky activities. And all these, lower interest rates put more pressure on banks from both commercial and investment banking side, and that created actually an intense competition in the mortgage business. And another indicator is unemployment rate. As you can see, this is declining by until 2006-07. The next thing I would like to show you is the amount of mortgage originations and steadily increased to almost $3 trillion by 2006. But we could see slowing down, and in 2006 actually declined a little bit, and the share of subprime mortgage increased, and these mortgage-based securities, which were the main business line for investment banks, steadily increased. Here we can see the amount of foreclosures. In fact, when we look at the prime and subprime origination foreclosures as percentage of respective figures, we could see that foreclosures for subprime was stable. What it means basically that the problem or the source of problem was the decline in the housing prices. It was not delinquency or foreclosure. It was mainly about the decline in housing price that created the problem first. And here we see the number of employees and banks. These are all banking institutions in the United States. This is the percentage change. The first line is number of institutions as percentage change. We can see that after 2003, the decline stopped or became lesser. And in employment-wise, we can see the banks after 2002 started to actually they expand their business, and that went up until 2005, and after that they started shrinking again. And this is the, the rate of return as percentage of total assets for all, financial institutions. What we can see is that, interest income, if you look at the net interest income, it was around 3% and declining in general. But what kept banks running, in mid-2000s was this, non-interest income, the fees banks will charge to, both their customers and to each other. That kept, banks in the, profitable, area. So in terms of competition, we could see a number of players. That's why I said capital is not a monolithic category. It is because of ownership. It is plural, and these three banks actually disappeared by September 2008. And what happened in terms of Merrill Lynch? It is exposure to the subprime market was around $50 billion by 2006, but the situation got worsened in 2007. And in October 2007 and January 2008, actually Merrill Lynch wrote down around 20 billion of his assets. It was significant. And then, still had lots of toxic assets on its balance sheet and tried to sell them. Actually sold in July 2008 around the face value of $30.6 billion asset only to 6.7 billions. You can see the huge difference. Actually, that difference is also a kind of destruction of capital. And finally, try to find investors from around the globe, especially from the Middle East. But after realizing that it couldn't manage, it was forced to sell itself to Bank of America. What happened to Bear Stearns? In that case, what we see is that same thing. Started in 2007, suddenly. Even though, as we could see earlier, problems were going, the source of problem was going back to 2005 and 6. It took some time to realization. Actually, that is the reason why I emphasize the time dimension, in moving from commodity to physical form to money form. And it was very difficult for Bear Stearns to do the same thing of downloading the toxic assets because everybody else was doing the same thing. And it tried to deal with these problems like what Merrill Lynch tried to do. But what happened in 2008, March 13 was that this Carly Capital, which Bear Stearns owned around 15%, collapsed suddenly. Yeah. And then with this $22 billion of exposure to the mortgage market. And then suddenly investors realized that even the Bear Stearns could not finance its daily transactions, and they stopped doing business. Actually, that is the power of actors in the market to honor their transactions and also get into relationships with each other. Once the players stop lending and borrowing from Bear Stearns, the company didn't have another choice but to again to sell itself to J.P. Morgan at a fraction of its market value. And what happened here? Overall, what we can say that competition as a mechanism was very forceful after 2003. Lehman Brothers and Bear Stearns got into the market in the first place in 2003. Merrill Lynch entered the market in late 2005 and 6 by buying other the mortgage originators. So here, the investment banking in terms of power relation is based on short-term lending, giving assets and borrowing, and then when the asset values decline and also share price decline, and that created balance sheet problems for the banks, and then they could not carry out transactions, and the result was a kind of classic run on the bank by banks, actually, not the depositors in commercial banks we saw historically. As a conclusion, what I could say is that capital has these three dimensions: physical assets, funds, and power, and they are taking advantage of what the society sees as value. And it is a plural category. Why? Because of ownership, and business competition is very important to understand how the dynamics of the market play out. And in that process, this time and realization or conversion of money from commodity to or physical assets to money is highly critical. At the end of the day, there are always winners and losers. It means that actually capital is also a category for redistributing wealth in the society. Thank you.
Good afternoon, ladies and gentlemen. My name is Mladen Ostojić. I'm a MA candidate here at York University studying political science, and I'll be sharing with you today some of my preliminary findings from my research project on corporate taxation with an emphasis on American banking, something that I hope will become my major research paper down the line. Now, what got me into this topic is essentially my own ignorance. I really didn't know much about corporations, and much of what I did know, both in academia and outside of it, came from conventional wisdom that relied on anecdotal evidence, and I wasn't very satisfied with what I knew, and I wanted more. So what I did is I took the capitalist power approach, and I tried to figure out exactly how corporations have evolved. We hear all the time that corporations are strong, they are at the commanding heights of the economy, they have grown from relative humility to taking up a dominant place in modern capitalism. But I wanted to try to quantify this, and with the capitalist power approach, we have the tools to do so, and that is through capital as power, as the title suggests. So what I've done, essentially, is to take corporate profits. The issue was raised earlier, how do you quantify power? It is difficult. When it comes to corporate power, it's quite plain to see that profitability is a central component of corporate power, and measuring that will give us a proxy on how well they've been doing. Now, that was exceptionally difficult, but what I was more interested in was how taxation affected corporate profitability. And the relationship is fairly straightforward. Presumably, if you're taxed less, you can profit more quickly, retain more of your profits. Corporations, after all, are taxed on profits, and if you are taxed more, it stagnates your capital accumulation. So what I've done is I juxtaposed in Figure 1. If you're following me with the handout, it's a bit too big. Right. Corporate profits against the effective corporate tax rates. Now, the corporate profits here are strictly nominal. I didn't fix for inflation. I didn't compare it to any sort of other income. I just took corporate profits in general just to see the slope and how it evolves. This is a logarithmic scale, so don't look at it and say, wow, corporate profits have increased 1,000-fold. Yes, they have, but compared to what? So you shouldn't really worry about that. What I'm mostly interested in here is its relationship to the effective tax rate. And when I say effective tax rate, you should understand that I'm not talking about the statutory tax rate written in law. I'm not talking about what some bureaucrat is trying to impose, says 50% on all your profits. That may be the case, but corporations can get away with perhaps 40%. They may have to pay much more, much less. It depends. There are many things to consider: capital losses versus capital gains, tax evasion, outsourcing, many different things. Suffice it to say that corporations are pretty good at not having to pay tax. But back to the graph. What we see here is, first of all, a mild, subtle, but nevertheless existent inverse relationship between the effective tax rate and the pre-tax corporate profit, such that if the corporate tax rate goes up, we see that pre-tax corporate profits tend to stagnate and vice versa. Now, this is not the biggest deal. It's not really the point of my presentation. I'm just trying to set up what's to come. And the more important thing here is the effective tax rate itself. After the Great Depression and World War II, which were obviously crisis-ridden periods of capitalist history, when we get to, I suppose, the political economic normalcy, business as usual, we see that from a high of around 56% in 1943, at which point, presumably, there was a high demand on from the military to raise funds for the war effort. It fell all the way down to around 25% in 2009. Now, this is based on raw data. All of the data I have here graphically presented are smooth, meaning that looking at 5-year averages such that each point on the graph is actually the average, weight average of the last 5 years. So when I'm saying it fell from 56 to 25, that is in raw data, just so you know. And what I found, besides this, when I asked myself, okay, well, this is great, and it's meaningful in and of itself, but to say that corporate profits are going down, it's a gross generalization. Corporations are very diverse. There are many different kinds of corporations, many different sizes of corporations, so I decided to disaggregate. And when I did this, it really kind of knocked my socks off, as you'll see. So if you think that corporations are being undertaxed, take a look at figure number 2. What we see here is a huge disparity between the effective corporate tax rate and the effective corporate tax rate facing banking in particular. In fact, the average difference, and this is now based on smooth data, so maybe a little bit distorted, is 17%. There's a typo there that I corrected with my pen. Hopefully it's legible. 17% from 1929 to 2008. Banks have paid 17% less in taxes than the average corporation, which is kind of significant to say the least. Meanwhile, after World War II, we see that from a low around 4% in 1944, the share of pre-tax banking profits and all pre-tax corporate profit, in other words, out of all the profits that have been accumulated by corporations, that part which is belonging to banks has gone up all the way to 32% in 2002, only to come back down to around 14% by 2007. This is again based on raw data. Unfortunately, I don't have access yet to the data over the past few years. I emailed the gentleman who was in charge of the database I was using at the Bureau of Economic Analysis, and he basically informed me that the IRS has to clear it or something like that. It wasn't quite clear, but it's unfortunate because, as we've seen in the previous presentation, a lot of bad things have happened to banks in the past few years given the crisis. So it'd be interesting to see how this has evolved. I would like to point out, however, that in the 1980s, we see banks, I didn't emphasize this below, I should have, that the effective banking tax rate has gone down. In the smooth data, it looks like it's around 15. It's probably around a few percent. So they've paid almost nothing in the 80s. And we also see that their share in corporate profits has gone down tremendously for that period. This corresponds to, I'm not really sure what it means. Perhaps it's the Volcker shock where the Federal Reserve hiked interest rates and discouraged interbank lending, or perhaps it's something to do with neoliberalism. But I'll have to defer speculation because I really can't tell based on this data. But there's more. Banks themselves, as a sector, are more specific than just plain corporations, but even within banks, there's a great deal of diversity. So what I've done in figure number 3 is I've disaggregated along the lines of size by total assets. What I've done is essentially taken the top 20 bank holding corporate companies, which are more or less the same thing as banks in terms of size and makeup, by total assets in 2000. So in the year 2000, the top 20 corporations, I've taken them, looked at all of their profit data from 1960 to, I believe, all the way to 2010, because that data was available, or 2009. Excuse me, 2008, yeah. 2008. And what I found is kind of a progressive tax scheme, which perhaps contradicts what Sandy told us earlier. I'm not sure I understood that. Maybe you can get back to us. But what we see here is that the largest banks by total assets have been taxed at a higher rate, effectively, again, not in statutory terms, than the effective tax rate for all banks. And this, again, implies a heavily progressive tax scheme. And so, by the way, I'm terming these banks here as dominant capital now. That's a very particular term introduced not by myself but by someone else. I don't want to abuse it. I'm using it simply because presumably these banks, by virtue of being large, are able to beat the average in terms of accumulation. I'm not sure about that, but I didn't know what else to call them. Apologies for that. But what I want to also like to point out is that this data series is not complete in the sense that for certain banks, and there's a list of them in terms of ticker symbols in the footnote, 20 of them. I don't remember all of the names, but not all of them have their data from all the way from 1960 to from 2008. Some of them have only for 10 years, some of them have for 20 years, but on the whole, it turned out pretty well. The reason I chose the number 20 is not because it's some magical number, it's simply because it worked out the nicest graphically. When I looked at it, when I looked at the top 10, the top 5, the top 15, top 30, they all look pretty much the same, just messier, and this was the nicest variation I could find. Unfortunately, it doesn't go back beyond 1960, the individual bank data, but we can see that it's quite a difference. So, while corporations have had their effective tax rates decrease, and banks have particularly managed to sway this in their favor somehow. I don't know how. And this is no coincidence, and it's not a mistake on the part of the regulators. I'm sure they are aware. The top banks, at the same time, within the sector, have not been able to, shall we say, enjoy a favorable tax burden. So this begets some very big questions. How is it that corporations have done this? How is it that banks have gotten away with what seems like highway robbery and just managed to accumulate a tremendous base compared to other corporations while enjoying a very favorable tax rate? And why is it that the dominant banks have been taxed at a higher rate? Some of these things are consistent, other ones seem like contradictions at this point. I cannot offer much speculation, but the data itself, I think, is quite enlightening. I hope to study this more in the future, figure it out perhaps, maybe with your feedback, I'll learn something as well. Hope you find that interesting, and thank you very much.
It's just a small comment for Mladen, about the progressive tax system for the banks. Be careful because you're comparing two different types of profit data. The BEA adjust their profit data in various ways, so they might not be comparable with the stuff taken from Compustat. They wrote an article on it at the BEA, which I can send you if you want.
Please. Thank you. Jonathan?
I have a few suggestions for Mladen and a question for Tuna. The suggestion from Mladen, in addition to what Joe has indicated about counting differences between the different sets of data, The NIPA accounts have two sets of profit data. One set is with capital consumption adjustment and income valuation adjustment, and another set without it. If you are comparing your profit data with accounting data, probably you are better off with using the profits without capital consumption adjustment and income valuation adjustment. They are closer to the definition of the accounting data. And another point you might want to consider is that smaller banks, there are many banks in the US, there are thousands of them, and many of them experience losses. And these losses will end up being taxed at zero. So that might actually account for the major difference, because the large banks tend to be profitable, whereas small banks can be profitable as well as incurring losses. So these are suggestions in terms of how to explain this difference that you indicated at the end. The question that I had to Tuna, you were trying, I think, to mix several approaches, but I'm not sure that I understand the reason for that mixture in terms of what is capital. It's quite obvious that capital has something to do with tangible assets or with machines, in a sense that in every society, power has something to do with imposing itself on society, and in capitalism, that society is engaged in production. But the issue really, I think, is quite different. The issue boils down to quantification. So although capital has something to do with production and something to do with labor and something to do with machines, can we go and actually measure these physical entities or productive entities in a way that will inform the quantities of money and credit? So that's the major area of contention. To say that capital is tangible or physical, you haven't said yet anything. So I think this is the area that remains unclear in your presentation. And just as a question, what is exactly the tangible asset sets of the banks, for example? Thank you.
So,
Sure. Yeah, sure. Thank you very much for the question. Actually, measurement is a very big problem in the sense that, as I indicated in the literature review, economists have been trying to measure it for more than a century, and still, as Avi Cohen's article indicates very well, and also Jan Kregel mentioned earlier, that when it comes to measurement, there are lots of problems. I think that has to do with, again, what the society values as a whole. And that what the society values changes over time, and the owners of the capital try to actually get their share in competition with one against another. So I don't think that we can measure it properly, and as you know the literature very well, there are lots of discussions, debates how to measure. Should we measure the assets as the part of cost of production, or whether their future earning capacity? And you do as future earning capacity, even that can in that quantification there are problems again with how to bring interest rate into the equation, because change in the quantity of capital may be due to increase in the the physical assets, or it may be due to increase in the interest rate. So I do not want to go to that part, because it has been a century-year-old discussion, and I don't think that we can solve it here. Thank you.
any more questions?
Yeah, Mladen. My name is Eric. Well, we met briefly before. Look, I just want to ask you, on your last graph, this is, you mentioned this kind of counterintuitive. You see a higher tax rate for the biggest, or what you call the dominant banks. I mean, you left that up for speculation, but I kind of have a sense that you have a hunch. So I was just wondering what that might be, because I'm sure you have one.
Thank you for your question. The only really reason I said that is I didn't want to give the I thought I maybe gave the impression that if you're enjoying higher taxes, it must be because of lower profitability. So if you were to take that as my hypothesis, which is not really what I'm saying, you may have inferred that or expected that dominant banks would be taxed at a lower rate, which they were not. It was probably something I should have not said. So good call.
Yes.
Thanks very much. This is also to Mladen about the banking taxes. This is not an area on which I claim any expertise at all, but the question relates to whether these are national accounts and therefore whether profits may be hidden elsewhere, either in off-balance sheet transactions, offshore in tax havens or elsewhere, and therefore be taxed effectively at nil or at a much lower rate, and whether therefore you should be looking at the taxes paid within a particular national jurisdiction by banks and on their activities within that national jurisdiction or globally, and to what extent off-balance sheet operations, the use of tax havens and so forth might lead to different calculations.
Well, if that was a question, then I'd respond with that I'm aware of this and it had occurred to me, but I simply had no way of measuring at this point. I just went with what the BEA gave me, and I broke it down sectorally. Actually, this took quite a bit more calculation that meets the eye. It's not like they had the category that says banking. They had depository institution, non-depository institutions, credit agencies, and the guy I mentioned earlier told me how to add it all up, and it was quite something. And there is within these tables something called the rest of the world. But before tax and after tax for the rest of the world is the same, which, like you said, it's not being taxed. But I don't know what part of that is banking, what part of that isn't banking. So it's an excellent point. I wish I knew, and I hope to someday. So thank you. Probably not.
Thank you. A question for Mladen as well. More of a comment. It's just I was working on Eli Lilly, it's one of the big pharma corporation. Eli Lilly, 60% of its activities, it's in the United States. 60% of its sales, it's in the United States as well. But it's paying only 0.7% of its taxes in the United States. Basically, in terms of intra-firm trade capacity to basically evade fiscality is kind of important. Just a question, why do you focus on the effective tax rate in the US? Basically, you have 20 dominant banks. Just take the annual reports. So you have pre-tax profits versus declaration of everything they paid in taxes during that year. So that might be something interesting to basically ask the question in global terms instead of just in the United States.
To be perfectly honest, the reason I chose the United States is historically it's an important place for capitalist development corporation itself. But for the most part, it's because the data was available, and it's what I wanted to start with. You're absolutely right that today corporations are multinational in nature. They exist in many different countries. In a sense, you could say they don't exist in any country at all. But they're still headquartered somewhere, and you have to measure it somehow. And this is simply the way I approached it. Certainly, if we think about, for example, when I did the top 20 bank holding companies, how much of this is actually in the United States, really, when you think about it. So that's an excellent point. I recognize the importance of a multinational approach, but at this point, it's way over my head. I wouldn't know how to approach that, although I'm working on it.
And John, one at the top.
Hello. Allow me a small and quite simple philosophical remark about the fact that we should question, of course, our will to measure power and ask ourselves if power is not an ideology of measurement and an ideology of quantity that, of course, presupposes realities that are measurable. We are all familiar with Plato quoting Protagoras as man being the measure of all things. And from that sentence to another sentence that would be all things are measurable leads us to what I would call as one of the possible definitions of what leads to a creator is the power to measure and the power to define what is the measure. And this is why I think today power is capitalist, because we are trapped in, as Heidegger put it, we are trapped in a world of realities. And so therefore I think we should always try to avoid falling into trying to measure the measurement. And I think this is how actually I read Nitson's book. Is also, you know, it's not only about capitalizing the power, it's also about powerizing the capital. Thank you.
And Jonathan again.
The audience is supposed to ask questions, but I actually have a constructive suggestion for Jeremy. I'm just wondering if you tried to use DataStream as a database, because you indicated that you have trouble actually getting information about the banks. And DataStream has individual corporate data going back to 1973, and these are global databases, so they're not just limited to the United States, and they are available here at York. So I hope this is some sort of a constructive suggestion. Thanks.
And Joe? Yeah.
Hi, it's two comments and a question for Jeremy. One about DataStream for the UK. It actually goes back even further to the 1950s, the data, so it could be very interesting for you. So go to the Bank of England archives because it's fantastic. It's very open, and you can read all the correspondence between these lovely gentlemen in the Bank of England. It's good fun. And the question is the rise of the euro, have you thought about this at all? Is the rise of the Eurodollar market in London related to the exchange rate policy of the government? Living in the UK, I get the impression that the pound is kind of permanently overvalued. And I'm wondering if this is connected to the rise of the Eurodollar market.
So whoever wants to.
I'll go first. Hi. Yes, I did have a look at the DataStream data, and I think what I intend to do is look at the profits in the 1970s and then continue to kind of build the analysis. But unfortunately, I couldn't find for the 1960s the right data on British banks, and particularly the British banks that were involved in this kind of activity. So I think most of the data was on the clearing banks in Britain who weren't as involved in the Eurodollar market. So this is a bit of a problem. Although I had the data for the American banks going back sufficiently far, it wasn't available for the British banks. So I'm going to have to try and find my way around this problem somehow. Regards to Joe's comment, yes, I've already been sizing up a trip to the Bank of England archives. That's on my list of to-dos next time I'm in the UK. And yeah, regarding the exchange rate policy, I hadn't really given a great deal of thought to that. But what's interesting is that the late 1950s is when there are kind of devaluations of of sterling. So actually the value of sterling was coming down in this period, it seemed. I'm not sure if partly the reluctance to trade in sterling was also to do with the unpredictability of how it was going to be valued over time, given the fluctuations due to the stop-go cycle in Britain, which was this periodic crises revolving around balance of payments deficit, which affected the value of sterling in the 50s and 60s. But that's something I need to look into further, basically.
Yeah, a question at the top there.
This is for Mladen, and then I have a question for Tuna. For Mladen, it seems that what seems to be missing here is that, or sort of begs the question, that is presumably, even though dominant firms within the banking sector are taxed higher, it seems that generally banking is taxed less than the effective corporate tax rate. But what I'd like to see would be interesting with the top 20 firms in other sectors, comparison with the top 20 banks and their effective tax rate versus other sectors in the top 20 within them, and then you can sort of, because then it's sort of a comparison among equals rather than within the industry or the sector. For Tuna, I'm very confused about this notion of competition that you seem to put a lot of emphasis on. You speak of competition as a sort of mechanism, but I guess the blending of all the theories sort of make it kind of perplexing. What is it you're actually getting at? In particular, I mean, you sort of referenced Marx and Veblen. From my limited understanding, Marx's understanding of competition is somewhat progressive in that it sort of pushes society forward with the falling rate of profit and so on, whereas Veblen is it's very different. It's a form of sabotage, especially among the sort of oligopolistic firms that you sort of focus on. They're not really competing on price. It's on sort of seizures of intangibles and so on. So I don't know what you actually mean by competition. If you could clarify that for me, that would be good.
And we had another question from the gentleman down there as well.
Again, it's an outsider's view. I know, I've read that since the beginning of the accumulation of credit to launch capitalist endeavors, there's been a problem. And what the accumulators do is try to hide what they're doing. So the Council of Vienne, I think in 1311, after a century of Dominicans and Franciscans condemning usury, declared that usury was a mortal sin, and it really affected the people who were involved in it. And the statistics, I know from John Monroe, who wrote an article on it. It's known that all kinds of lending at high interest was going on, but it is not recorded in the bank accounts, in the records that were kept. Doesn't this motive persist? Is there something in modern capitalism that requires that true data be recorded somehow, somewhere, so that the wielders of capital can deal with each other? Or is there no compulsion for this? Is it that the data you want to measure will never be available, and things do exist even though they can't be measured? Maybe that's behind your not wanting to address quantification of power or other such things.
Yeah. Thank you very much for the questions. Let me start with competition. we have been hearing this, the term dominant capital. But when I show you, how the banking, competitors on the list, we will not expect, Merrill, Lynch, or Stearns, or Lehman Brothers, will disappear overnight. If we really, bought the idea of dominant capital. What I am trying to, say that, because of ownership, capital is a plural category, and we need to understand the struggle between them because they try to get a share in the distribution of wealth in the society. So without competition, that is not possible. In terms of Marx and Veblen, initially Marx's understanding of competition in the 1850s is very dynamic. But later on, he talks about centralization and concentration. In that sense, his understanding of competition is similar to what Veblen's would talk about in terms of cartels, in terms of curtailing, the quantity to sell at a higher price. What I would like to say is that I am not against measurement, but measurement has its own limitations because if let's say Stearns stock is valued at $70 yesterday and then today decreases by 50%, how can we measure it? So measurement is is relational, against what? Measurement is relational to what the society values. One day, stock is $50, the other day is $20. Again, it depends on the perception of the society as well as it depends on how players control resources in the society. If we didn't look at business competition, we will not see how things play out and we get a result that we see today. That's my point. Otherwise, I'm not against measurement, and measurement is essential for valuing what the society values in quantity. I think that's what I can say for now. Thank you.
Does anyone want the last word?
I suppose there was a comment directed to me towards me as well with respect to dominant banks versus dominant corporations. That was exactly my next step. I just didn't get there yet. Sorry, but I'll fill you in when I see it. Thanks.
Going once, going twice. Okay.
This question is for Tuna. You suggest that corporations can have very high capitalization one day, and then next day, all of a sudden, they have a very low capitalization, and then how can we measure it? George Orwell wrote a book or an article on which a book was based, collection. It's called Under Your Nose. Aren't you actually measuring it by saying that one day it's 100 and another day it's 20? Isn't this kind of a measurement how the society views these magnitudes, and in particular how the capitalists view these magnitudes, because they are constantly assessing the future flow of earnings, the future changes in risk, the future changes in the normal rate of return, and they distill all those forms of assessment into the price of the stock. So you actually have this type of assessment in front of your eyes. Whether this is a measurement of power or not is a theoretical question, but the measure of what society assesses and what society views as central is right there. So what you're suggesting is that this measure is really not the measure, and there's something hiding behind it that is the measure. And I think this is a problematic statement, because you are referring to some mysterious quanta that exist out there, and they are actually the reflection of what society believes. And the quanta that we see in front of our eyes every day, they are some form of illusion. Of course, they could be illusionary in the sense that human beings are mistaken about the future, but they're certainly reflecting the views about the future of the most important human beings in society as far as capitalism is concerned. Thanks.
Maybe quick. Thank you very much. That's a very good question, the observation in terms of understanding measurement. But if, when I was doing research, I could see, some investment companies could see, Merrill, Lynch, and Bear Stearns problem in 2006. And some other firms will measure them in a very high positive manner. So again, what I'm trying to say, there is no one measurement. And that brings us back to, as you suggest, about power relations. Power, again, plays out in a relational mode, as one of the first presenters mentioned and explained it earlier today in the morning. So again, there is no one measurement. If we look at, for instance, these investment companies' valuations of different companies, we will see lots of differences. Again, there is no one way of valuing a company. Some investors say it is buy, some say it is neutral, and others say sell. So how can we make sense of all these different valuations? That's why I'm arguing that capital is not a the monolithic category because of the ownership, and ownership is actually a conflictual category where we see different capitals are just struggling and cannibalizing each other if there is not enough profit opportunities.
Okay, great. Thank you very much, everybody. We have a 1-hour lunch break now, and we'll reconvene here at 2 p.m., where we have two very exciting keynote addresses by Bob Jessup and Randall Ray. So please be sure to come back after you eat. Thank you very much.